Hello, my name is John Belton, Portfolio Manager for the Gabelli Growth Fund, the Gabelli Global Growth Fund, and of course the Gabelli Growth Innovators ETF. At Gabelli, we build balanced growth portfolios with holdings diversified across sectors and with exposure to several exciting secular growth themes. This balance stems from our relatively flexible framework for identifying good growth stocks. We look at everything from tech high flyers to stable compounders and everything in between, and believe that great growth investments often result from technological, business model, or financial innovations. This word innovation is the common thread that runs through all of our portfolio companies. We invest in innovative market leaders best positioned to capture secular growth opportunities. So today, I'm going to focus on one of these secular growth opportunities that is shaping many of our holdings, and that is artificial intelligence and machine learning technology. While ChatGPT's third birthday is only 2 months away, it's becoming clear that adoption of AI technologies by consumers and businesses is only just now starting to really take off. And I'm going to walk through our views on where we are in the AI infrastructure investment cycle, which participants are seeing the most promising early returns on invested capital, and what major commercial use cases might be coming next. Of course, I'm going to also talk about how these insights shape the way that we are investing to get exposure to this promising technology at Gabelli.
All right, thank you all for joining us today. My name is Ben Pontious, and I have the pleasure of introducing John Belton, who oversees our growth strategy here at Gabelli. First, for a bit of background on the firm, Gabelli was founded in 1977 by Mario J. Gabelli and has since grown to over 30 billion in client assets under management. This is spread across a number of different vehicles, namely our closed and open-end funds, ETFs, separate accounts, and our alternatives products. Today, we will be hearing from our growth strategy as John walks through the team's view of the artificial intelligence space. John joined us as Managing Director and Portfolio Manager 2 years ago from Absoluto Partners, which is a long-short fundamental equity hedge fund, where he served as partner overseeing the firm's technology investments. Prior to this, John attended Boston College for a degree in mathematics, Columbia Business School for his MBA. He is a CFA charter holder and has 13 years of industry experience. John is also a long-suffering, though unwavering fan of the Chicago White Sox. With that, I'll pass it over to John.
All right, nice to be with everyone virtually. Thank you, Ben. As Ben mentioned, I'm John Belton. I look a little bit less tan now than I did in that pre-recorded video, which I took the day I got back from summer vacation. I'm going to give probably a 25-minute overview on our views on the artificial intelligence space, and then we'll open it up for Q&A thereafter. So without further ado, I have some slides to accompany the presentation. Okay, here's the agenda. So I'm going to walk through an overview of the generative AI market. How big is it? Where are we in the investment cycle? Where are we in the adoption cycle for consumers and businesses? I'll talk about returns on capital spent on generative AI investments. So who's earning attractive returns and where are things a little bit more speculative today? And then I'll talk about some of the early use cases, some of the future use cases, and some of the business models that are evolving around generative AI. And finally, I'll put this in the context of what we do at Gabelli Growth and walk through how we're investing behind the theme. Okay, so here's a snapshot of the market, one way to think about the market, but I think the point here is this is officially a market that's at trillion-dollar scale. So you take the 5 largest builders of generative AI infrastructure, those being Amazon, Microsoft, Meta Platforms, Alphabet, and Oracle. Collectively, those 5 companies are going to spend about $1.2 trillion in capex cumulatively between 2019 and this year. Of course, this is only one way to measure the market, pretty simple way to measure it, and it excludes other large builders of AI infrastructure, the Chinese internet platforms, Tencent, Alibaba, and ByteDance. It excludes also some of the neo clouds like CoreWeave and Nebius, but nonetheless, safe to say this is a massive market, a $1 trillion market, you could say. This is the same data presented differently, but I think the point here is the market investments in generative AI infrastructure have massively accelerated over the last couple of years. Probably not a surprise to many of you, but I think it's interesting to note that this big inflection we've seen in investment dollars kind of coincided with the launch of ChatGPT coming up on 3 years ago. I think that was really an aha moment for the industry, a kind of come to Jesus moment. Those top 5 companies, they're expected to spend in capex about $380 billion this year. That's up from the same 5 companies spending about $70 billion in 2019. So more than a 5x increase in just 6 years. And that 380 billion figure, that's been revised 15% higher just in the last month since second quarter earnings were reported. It's been revised 35% higher year to date by Wall Street, that is. And it's been revised about 75% higher in the last year. So the magnitude of investment just continues to positively surprise, or to surprise to the upside, I should say. And a lot of the stocks that are, that are benefiting from those investments are seeing positive earnings estimate revisions, which of course drive positive stock price performance. Here's the numbers behind these charts. So again, top 5 AI infrastructure builders spending close to $380 billion this year. That's roughly the size of the GDP of South Africa. It's up, let's see if I can do the math here, about $135 billion versus last year. So added the GDP of Morocco in a year. Just an extraordinary scale for this AI infrastructure market. And those are public companies, of course. In the private markets, another measure of sort of capital markets activity in generative AI took what we think are currently the 7 most valuable AI private companies. And if you take just the latest fundraising marks for these 7 companies, so we call them the supercompute 7, the answer to the magnificent 7. These 7 companies aggregate to about $770 billion of valuation. And that's up whatever the math is, 25x or so versus 2 years ago. So obviously a lot of excitement about AI in the private markets as well as the public markets. So yeah, ton of spending, a lot of capital markets activity, but what about adoption? Is this technology really useful, or are we just buying tulips in the era of the tulip crash? Well, I think what we're noticing here is on the consumer side, adoption is really starting to inflect. But what's interesting is it's taken a couple years for adoption to start to inflect. So this looks at ChatGPT's weekly active users. And so, they were growing at a pretty healthy clip after the launch 3 years ago for a couple years, but the weekly active users have gone from about 200 million to 700 million over the last year or so, and really started to hit a steep point in that adoption curve most recently. And this is kind of the same data, but just presented a little bit differently. This is the number of months that ChatGPT has taken to reach the next 100 million users. So it took about a year to go from 0 to 100 million weekly active users. Took another 9 months to get to 200 million weekly active users, 4 months to get to 300 million, et cetera, et cetera. And going from 400 to 500 million weekly active users took just a month. So clearly, adoption of ChatGPT and many other consumer AI services really just now starting to inflect. Go beyond ChatGPT. These are a bunch of other major AI services that are in the market today. Various metrics to measure adoption across these services. Just look at Google Gemini, the top row there. So Google CEO Sundar Pichai, during the company's second quarter earnings report about 6 weeks ago, disclosed that the tokens being generated by the Gemini platform, tokens is a measure of usage. It's basically a model's output. So we can think of one token as roughly being equivalent to one English word. So it's pretty good and interesting measure of usage of these models. But tokens being generated up about 100x year on year, and annualizing at 11.8 quadrillion tokens per year. That's a pretty big number. I don't even know how to conceptualize that. So let's go to, okay, so we've established a lot of dollars being spent. We've established that adoption is really starting to take off. So who's making money on any of this? Are any companies actually earning good returns on these big investments? So I'm going to walk through two what I believe to be major commercial use cases that are already working at scale today. Then I'm going to talk about a couple of use cases that are starting to commercialize with promising early results, and then I'll touch on, some of the future use cases we can really dream about at this point. So that first major commercial use case that's at scale today is digital advertising and digital media. And it is no coincidence that the three largest digital advertising platforms in the world, Alphabet, Meta, and Amazon, are three of those largest 5 AI infrastructure builders. No coincidence. And digital advertising is just such a perfect fit for AI because these companies are using AI in their content recommendation models to get the right content in front of the right users. They're using it in ad targeting, get the right advertisement in front of the right impression. They're using it in ad attribution and measurement, figure out how effective was an ad that a user saw. And then most recently, they're starting to use it in the creative process. So actually generating a customized advertisement for a specific user or for a specific impression even. Mark Zuckerberg, he talked about this on the company's first quarter 2025 earnings call a couple months ago. His vision for what Meta's aim is with generative AI as an ad platform is pretty amazing. It's just a one-stop shop. A customer or an advertiser comes to Meta with an objective. I want to sign up a million. I want a million page views. I want a million new registrations on my website. I want 10,000 new app downloads, or even I want to generate $10 million of revenue with this product. Facebook is basically saying with AI, they do the rest. They'll find the users, they'll design the advertising strategy, they'll measure the effectiveness of the ad, and they'll even now create the ads to go alongside all that. And what does that mean? Well, this is just Facebook and Google. Google, of course, owns YouTube, but these two companies alone, clear inflection or acceleration in top line growth since they started to meaningfully invest in generative AI, or in AI, I should say. So I think the strategy is working. Using AI in the ad business is clearly working. And these Meta actually provided a pretty interesting stat during their latest earnings call where they said that improvements to their content recommendation models, the latest round of improvements, drove a 5% lift in engagement on Facebook and 6% lift on Instagram just by making their content recommendation models smarter. More engagement means more ad dollars, and 5 points of lift to ad dollars at this scale is very meaningful. These companies are collectively generating, I think it's about $450 billion of ad revenues this year. And putting numbers behind this, actually, so $450 billion across Facebook and Google in advertising revenues that the street is expecting this year. That's up from about $300 billion, and that's billion, not million. $300 billion of ad revenue in 2022. So that's an incremental $150 billion of ad revenue just for these two companies over the last 3 years. Now, this is way oversimplifying it, but if I tie this back to capex, Facebook and Google have cumulatively spent about $200 billion of capex since 2022. So again, oversimplifying it, but $200 billion of capex for $150 billion of high margin ad revenue. I would say that's a really attractive return. So it's no wonder they're spending so much on AI infrastructure. That's an equation that clearly works for these companies. And it probably goes without saying based on the last chart, but at share of global ad spend that's accruing to Facebook and Google clearly accelerating. So we started to see share level off in 2021, 2022, and kind of the low 40s% of total global advertising spend. That has re-accelerated back expected to be slightly above 50% this year. So just amazing growth at scale thanks to AI investments. Next major commercial use case we'll talk about is cloud computing. And again, it's no surprise that the four largest cloud computing platforms in the world, or cloud service providers in the world, are within that group of five largest AI infrastructure builders in the world. So in order, the four largest cloud platforms are Amazon, Microsoft, Google, and Oracle. And so AI is impacting these businesses, these cloud businesses, in two primary ways. So first, generative AI has created a new customer set for these companies. So leasing out AI infrastructure to model builders and to other companies that are building generative AI applications. That's been kind of a new revenue vector for these companies. But more importantly, I think, is generative AI has bolstered the core cloud infrastructure business, because the existing customer base, there's a new urgency to migrate IT to the cloud, to get data estates in order and bring them to the cloud so that the data can be harnessed in AI applications and AI use cases. And so what we'll see, these concepts are summarized in this quote by Andy Jassy at an earnings call earlier this year. And he's saying, look, AI is making cloud migration very important, top priority for companies. They recognize that to get the full benefit of AI, they must move to the cloud. So similar to digital advertising, we're seeing these cloud platforms deliver incredible growth at scale. So revenue across the four largest cloud service providers growing at a 30% CAGR since 2021. I cheated a little bit here. That's a little bit pre-ChatGPT, but closing in on $300 billion of revenue across the group. But same point as digital advertising, most interestingly, we're seeing a big acceleration since in that kind of post-ChatGPT era, where these companies are seeing revenue growth accelerate as AI investments have been made and are being made. And actually, this, I will say, I didn't quite yet update this chart specifically for the quarter that Oracle reported 2 nights ago, but needless to say that this acceleration would look even steeper with those revised Oracle numbers. Okay, so I think we've established AI huge market. We've established that the biggest investors in AI infrastructure across digital advertising and cloud computing are already generating very attractive returns on this big capex. Now we're going to look at, what are some of the emerging use cases and what are some of the future use cases. Before getting into that, I think that the broad point to make to set the stage, the broad points to make is that first, AI technology is becoming cheaper to use. Models are becoming cheaper to operate, cheaper to inference. And I think that is making the technology accessible to more customer types and to more use cases. And so this chart shows a recent study done by Stanford University, which estimates that inferencing costs have fallen by a factor of 300x over the last 3 years. And I will say also some of the newest large language models, in particular, OpenAI's GPT-5 model, are, I think, going to further accelerate this bend down in the cost curve. A lot of interesting stuff being done to optimize the cost of inferencing models. And again, cheaper models is going to make the technology accessible to more companies, more users, and more use cases. Simultaneously, we're seeing capabilities in these models get better and better. So models are becoming cheaper and they're becoming more capable. So we're seeing across many different disciplines, these models are starting to exceed human capabilities. So this slide's talking about the progress that's been made in areas like image recognition, reading comprehension, language understanding, and in particular, the really steep improvements there in science and math. So these companies are now across many disciplines exceeding human capabilities in a lot of the most widely followed and respected benchmarking tests. And so with cheaper models and with more capable models, we can think of AI technology as being a good fit for various corporate productivity initiatives. And Jensen Huang, NVIDIA's CEO's vision here is that AI is poised to break into what he estimates is a $50 trillion pool of labor costs. So the first use case I'm going to talk about is corporate productivity and kind of labor replacement. AI being used by companies to take out costs and to replace workers or to drive down wages. And so we're starting to see success here show up in some of the soft data. So in some survey data. So this is a survey done by McKinsey, a recent survey done by McKinsey, which interviewed business leaders across several corporate disciplines that are using AI today. And if the first point is respondents to the survey, more than 50% of respondents across supply chain, HR, strategy, service operations, legal, and software development are already using AI to cut costs. And then interestingly, I went too fast there, but also more than 50%, more than 60% of respondents are using AI across strategy, marketing, supply chain, and operations to generate incremental revenues. So I think there's early indications that AI is starting to be used across the company, across the enterprise to cut costs and to make the company more efficient. And so some of the large enterprise software companies are starting to tap into this concept or to this opportunity. And they're starting to do that in an area that we'll refer to as agentic software. So agentic software is a software application that can autonomously complete tasks without the need for human intervention. And so the monetization here is still pretty early, but it's starting to really take off. And I'd argue it's the early results are very promising. So take ServiceNow as a good example here. That's a company that we own. They're an early leader in agentic software monetization. Their so-called Pro Plus modules, which they use to so these products can automatically diagnose issues, recommend troubleshooting, respond to basic queries. So maybe a user needs a password reset. ServiceNow's Pro Plus SKU can actually do that automatically. And they also automatically generate case summaries. So IT executives, the job of IT executives that are using these Pro Plus products is getting easier. And analysts are thinking that the Pro Plus SKUs, so the agentic software business, is going to be about 10% of the total revenue base by next year. And this product was non-existent, 18 months ago. So still early, but very promising. Software development, another exciting use case that is starting to enter commercialization. So this, if we just take commentary from executives at Alphabet, Meta, and Microsoft, we can see that these companies are already using generative AI to generate between 30 and 50% of all the internal code base at the company. So greatly reducing the need for software engineers. I don't think the job of a software engineer, I think, is changing. I don't think it's necessarily going away. But Microsoft, interestingly, thinks that the vast majority, almost all of the internal code base by 2030 is going to be generated by AI. Another emerging use case, not quite yet at massive scale, but very promising and in the field, in production, is autonomous driving. The poster child here is Tesla. Tesla uses AI entirely for their full self-driving platform. They don't use any radar. They don't use any LiDAR. All they use is cameras and large language models, which is pretty amazing. They've launched a robo-taxi service, as many of you are probably aware, in Austin. They're going to be rolling that out to many more cities over the coming quarters and years. Their existing fleet is equipped with full self-driving, and I think it's not quite ready for full prime time yet, but it's worth mentioning that, first of all, the quarterly data that they provide suggests that it's already about 10 times safer than the national average. Drivers using full self-driving are getting in 10% as many accidents as the national average. And the full self-driving platform benchmark to itself, there's been about 160% improvement in miles per accident since 2019. So I think autonomous driving is clearly a future use case for AI that is starting to enter commercialization. Now let's dream about the future. So we've talked about, the major use cases at scale today, digital advertising and cloud computing. We've talked about a couple use cases that are in production, being commercialized, but still early. Those being corporate productivity, agentic software, software development, and autonomous driving. Now let's think into the future. I think some of the other areas that are promising in sort of research labs would be robotics, industrial and humanoid robotics, various areas within healthcare. So things like drug discovery, protein sequencing, diagnostics, various use cases in medical devices, and a lot of clinical care use cases as well. And then use cases to improve clinical care, that is. And then finally, defense. Drones, different weapons, the security systems, etc. So let's tie it all together. 4 major takeaways for this part of the presentation. First, investment in AI infrastructure has reached trillion-dollar scale. It's showing no signs of slowing, keeps surprising to the upside. Second, adoption of AI technology is only now starting to hit a really steep part of the so-called S-curve. Third, the largest builders of AI infrastructures are generating the highest returns on invested capital today. So that should give us comfort as investors. And then finally, use cases are starting to broaden out. We've got some examples of use cases that are already being commercialized, but are still early. And then we've got a laundry list of sort of future use cases that we can dream about. So I'll now spend a couple minutes talking about how we're taking all these views and what we do at Gabelli Growth, and then we'll open it up to Q&A. First, I think just worth walking through quickly our investment philosophy at Gabelli Growth. There's kind of 3 pillars here, and it's not rocket science, but what we're trying to do is we're trying to find really high quality and innovative companies. We're trying to find catalysts that are going to make these good companies good stocks within a measurable time horizon. And then we're going to, with these good stocks, try to build balanced and concentrated portfolios. And one of the things we do when we identify quality companies is we have a bunch of investment themes that we're trying to express. We like to be a little bit thematic. And AI is a perfect example of a theme we're really excited about. So we study AI, we come up with a bunch of investment views on AI, and then within that theme, we're going to try to find the best companies that are, not going to be flash in the pan beneficiaries of AI, but are going to be companies that can create durable competitive advantage from AI. Here's some of the themes that we are invested behind right now. You can see AI, or advanced computing and machine learning, in the upper right. But the other themes we like: enterprise digital transformation, digitization of media and consumer, a couple different interesting areas of medical technology, and then some secular industrial themes like electrification, clean energy, and secular growth in aerospace. And then final slide. This is how we're currently invested in our AI theme. And so these are what we believe are some of the best, highest quality companies that have a proven business model, strong revenue growth, strong returns on invested capital, innovative management teams that we think are best positioned to capitalize on this AI trend. So we've got a couple plays in the semiconductor space. We've got the 2 chip designers, the two leaders in AI chip design, NVIDIA and Broadcom. We've got a couple companies that go into the semiconductor manufacturing process, ASML and Applied Materials on the equipment side, and Cadence on the software side. We've got a collection of companies that are helping to facilitate the data center build out that is going to be needed in AI. So we've got power generation exposure with a company like GE Vernova, power management exposure with a company like Eaton, cooling exposure with a company like Trane, and then data center management exposure with the cloud platforms, Microsoft, AWS, and Google. And then finally, we have a small but hopefully growing list of companies that we think are poised to monetize AI on the application side. I talked about ServiceNow, CrowdStrike, a cybersecurity company, Intuit, a small business software provider that's starting to use AI across a bunch of their different product offerings. You can see the rest here, but I think with that, I will bring Ben back up and the two of us will open it up to questions.
All right. Well, thank you, John, for the overview. It's always interesting to see how you are interpreting the current environment and the trends that are emerging. I think the first question I'm seeing in the chat is relevant to that. The question is, when will the AI infrastructure investment cycle peak? You showed the growth over the last few years, but what about the next several?
That's the question that everybody is asking right now. I think a couple points I'd make. So first of all, it is worth just reflecting on the magnitude of upside surprises we've seen in AI capex. I mentioned it earlier, but you take those 5 AI infrastructure builders, Microsoft, Amazon, Meta, Alphabet, Oracle, aggregate capex across those companies, Wall Street expectations, 15% positive revision over the last 2 months. I think it's 35% positive revision since the beginning of the year, 75% positive revision over the last year. So it has been massively positively surprising. It is frankly impossible to pinpoint when that cycle is going to peak. It is inevitably going to peak at some point. This is a capex cycle. All we can do is watch at the application side to make sure this technology is ultimately going to be as useful in as many areas as we hope. And so long as it is, I think the capex cycle can go on for quite some time. The last point I'll make is we get from time to time some encouraging data points that give us comfort in the durability of this cycle. And we got some of those data points 2 nights ago when Oracle reported earnings. When Oracle reported earnings 2 nights ago, they provided 5-year guidance for cloud revenues. And they provided it, interestingly, for every year between now and 2030. And the ramp that they're guiding, which is based on their existing customer backlog, is suggesting that this cycle has another 5 years to run before it peaks. So kind of a non-answer, I guess, but I think it's been positively surprising. We are going to have to watch sort of the monetization of AI to ensure that the cycle can keep going. But the most recent data points suggest there are at least a couple more years of robust growth ahead.
Great. It's very exciting. Like another question I'm seeing here are, what are the different AI strategies and exposures across these magnificent 7 companies?
First, I'll say I believe we will share the slides. So there's a couple questions about that. The question is about the Mag 7, which get a lot of attention in the financial press. First of all, I think the Mag 7 they get a little bit hated on. Only 4 of the Mag 7 have outperformed the S&P 500 year to date, and none of the Mag 7 are top 50 S&P 500 stocks year to date. So just level set. I don't think this has totally been a as concentrated a market as the financial press likes to say. But the different AI strategies across the Mag 7, well, I think we talked about digital advertising for Facebook and Alphabet, or for Meta and Alphabet. We talked about cloud computing for Amazon, Alphabet, and Microsoft. I think Tesla, we talked about autonomous driving. Apple is sort of the notable omission. I think the AI strategies for Microsoft and Amazon clearly to be infrastructure providers, and Alphabet to an extent too. For Meta, I think there's a little bit of there's a play on being a model builder with Llama, and then there's a play on just using AI in their core digital ad business. Tesla, I think clear AI strategy is autonomous driving, full stop. Apple, we're still learning. I think right now it seems that Apple is going to do in AI what they've done in every tech cycle before. They're just going to be a distribution mechanism for AI technology. Apple owns the consumer. I think their capex has really not budged from the single-digit billion-dollar range, which in the context of these other companies is nothing. I think they are taking more of a capital light approach, and they're saying, all right, we will provide the kind of app store, if you will, We have the consumer. If you're a developer building an AI application, we'll give you a platform to distribute that AI application through, and we'll take the toll on that. Apple's also, they're not really doing much on the model side. I think they've got the OpenAI integration. So I think to me, Apple is, we're going to be really good at AI on device, and we are going to be a distributor of AI on behalf of third parties to our existing customer base.
Well, I guess following that up, on the flip side of things, which companies do you see to be most at risk from the proliferation of AI?
Yeah, I think that's a very good question. So first, I'd say the big theme on this front in the market today, there's a big focus on enterprise software companies. We talked a lot about corporate productivity initiatives and agentic software, and there's kind of two potential problems, or I should say two perceived problems for enterprise software companies. Number one, is agentic software going to disrupt these incumbent enterprise software businesses? And enterprise software has been such a great area for investors over the last 10, 15 years. It's just really high quality businesses, recurring revenue, high margins, very scalable, relatively capital light. These are stocks that have traded at really high valuations for a long time. And I think what's happened over the last year or so is a lot of these stocks have come under threat. And I think there's a view that agentic software is going to render a lot of existing incumbent enterprise software businesses as, less important, less useful, potentially put downward pressure on pricing, and even cause customer attrition. Simultaneously, I think what we're seeing we talked about the automation of software development as another use case. We're seeing software development. There's this concept of vibe coding, where with AI, basically anyone can be a software engineer. There's these kind of automated software development services where you can effectively start to code in English rather than in C+ or in BASIC or in Python. And so I think there's this view that the barrier to entry for a new software company is coming down. So there's just going to be more competitive pressures in the area of enterprise software. So I guess the area I'd highlight in response to the question is enterprise software. And I think the threats are, agentic software disrupts this amazing existing business model, forces companies with awesome businesses to pivot, always risking that. And then B, vibe coding or automated software development lowers the barriers to entry for new software, threats to come in.
So you talked about enterprise software being more at risk. Another question, which sectors in the AI supply chain are best positioned from a business, competitive, valuation, and fundamental standpoint?
Yeah. So who's best positioned? I think it's a bit of an open-ended question. Right. I'll talk about what we like right now. So I think the chip space right now is really well positioned, and you're seeing that in the stock performance of NVIDIA, and more so Broadcom of late. But I think all of this has to rest on semiconductors and on advanced semiconductors, and it really is semiconductor advancements that is unlocking all this improvement in model capabilities and in application development. And so I think these semi companies, whether on the design side or on the manufacturing side, in the case of Taiwan Semi, I think they've established these really impenetrable competitive moats. And so I'll focus on NVIDIA and Broadcom first. But so NVIDIA has, I would say, a 10+ year head start on everyone else in developing advanced semiconductors or parallel processing semiconductors. And one of the things that they've built during that time
is effectively a programming stack or a programming language called CUDA, which has over 4 million active developers working on it today. And what CUDA does is it makes it more efficient and easier for users of NVIDIA's chips to program applications that are suited to the chips. And so I think that is a very hard ecosystem to replicate. And I think that is a really durable competitive advantage for NVIDIA. And so I think that they're releasing new products every year that are getting better and better. And it's just the gap between them and competition is widening. What Broadcom is doing is a little bit different. They're saying, okay, there are basically a small handful of massive companies globally that are investing in massive scale in AI infrastructure. Why don't we go to some of those companies and say, hey, you can use NVIDIA for a lot of what you do, but we can design a more custom chip for a specific thing you're trying to do that does it a little bit more cheaply than what NVIDIA can offer. So I think Broadcom is taking this really innovative approach to, I don't think they're trying to compete head on with NVIDIA, but their moat is going to be their customer relationship. So they have big deals with Alphabet. That's almost 10 years old now. They've got also big deals. They just announced a new big deal with OpenAI. Point being, I think they're very well positioned as well.
Thank you, John. It looks like we are running up against time shortly. John, if you have any closing statements.
Well, thanks everyone for joining. We did get a couple questions. We will share the slides. And please feel free to reach out to Ben or myself if you have any follow-up questions or want to discuss anything further.
Investors should carefully consider the investment objectives, risks, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800-GABELLI or visit www.gabelli.com. These ETFs are different from traditional ETFs. Traditional ETFs tell the public what assets they hold each day. These ETFs will not. This may create additional risks for your investment. For example, you may have to pay more money to trade the ETF shares. These ETFs will provide less information to traders, who tend to charge more for trades when they have less information. The price you pay to buy ETF shares on an exchange may not match the value of an ETF's portfolio. The same is true when you sell shares. These price differences may be greater for these ETFs compared to other ETFs because they provide less information to traders.